Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
So, welcome back everybody to another episode of the Finance Garage. As always, Jonathan Wu here as Principal and Senior Financial Advisor at the SW Group. And today I'm very privileged to have Matt Brown, who's the CEO of Advice for Fortnum and PFS, which is part of the Entireti Group, joining me today. Welcome, Matt.
Hi, Jonathan.
So, Matt, just to kick things off so that people can sort of get to know who you are, what's your role at Entireti, running two licensees?
Yeah, so a licensee, people might not know exactly what that is and wonder what it is. So in Australia, to give professional financial advice, you need to be licensed. It's called an Australian Financial Services Licence, AFSL. We own and run such licences. Professional financial advisors who can choose to go and get their own licence or partner with someone like us to utilise our licence, and we provide business services for them. So my role here is to run two of those licenses. So we maintain standards, we ensure that our advisors are professionally trained, we ensure that they can rely on us to make sure that the advice they give is both cutting edge from technical competence, and is it the best advice, and are we doing it compliantly within the bounds of all the laws and what we need to do, and ensure that the client's best interests are met. And for that we partner and we provide additional kind of services to businesses like yours, Jonathan, to say, well, how can I be a better business and how can I get to more people?
Yeah. So we're here today to talk fundamentally about the financial advice gap in Australia, right? And structurally, why aren't more Australians seeking advice? Like, I've been doing this for 20 years this year. And, we broadly, one of the, my little, pet peeves is, Aussies broadly love property, and we'll talk about that a little bit later, and some sort of tips and tricks that people need to understand. But if we sort of kick things off, how do you see the current landscape of financial advice? What do you see in terms of statistics and also the advice gap in of itself?
Really good question, and one we think about a lot. And I think there's maybe a couple of aspects to that, Jonathan. There's an advice need and there's advice demand. Because I think the need is huge. Australians, people, mums and dads in this country, don't live in a vacuum or in isolation. We live in a global world which has stuff going on all the time that impacts us financially. There's a lot of talk today about cost of living. There's lots of talk about, well, what's my retirement savings look like? How much have I got in super? How's that impacted by market returns? And all of that stuff. It's actually quite complex. Historically in Australia, I think the stat is something like 20%. 2 in 10 adult Australians get professional, personalised financial advice. More recent, and that's been pretty stable for probably the 2 decades that you've been a financial advisor, Jonathan. What fascinates me though is 2 things to that. Well, why aren't the other 8 out of 10 getting financial advice where I suspect they need to? And there's lots of reasons for that, and it'd be individualised why people in it themselves. But there are some thematics to that if you think about it. Well, some people have this perception that, well, professional financial advice would only be for people who are really complicated, or they've got lots of different companies, or they're really, really rich and they want someone to help them. Where do I put all this money I've got? Unfortunately, some will have seen over a period of time some poor advertising or media around financial advice that was probably an issue 5, 10, 15 years ago, and perhaps they've got this misconception about what professional financial advice is or isn't. Or some sadly have maybe dabbled into financial advice and found the process either confronting or complex. And so a whole mix of those things are probably why the 8 out of 10 historically in a period haven't received financial advice. Some of those 8 out of 10 think they have. And by that I mean they either read a financial book, The Barefoot Investor, bloody great book.
I agree.
Actually,
I've read it,
and
yep.
really insightful, a really good fundamental education around what are the tips and traps and what are the things like. It kind of helps to understand, but it doesn't tell me what to do. I can get onto the web and find information anywhere.
Yep.
So access to information actually isn't financial advice. A lot of people think it is. Actually, good professional financial advice synthesises all that information and tells me, yeah, that's great, Jonathan, but should I do that? Is that right for me? And that, I think, that and the emergence of finfluencers and what I can get on the interweb and various spruikers, and you mentioned earlier, property is one of those, and I think that's an important conversation to have because whilst they're absolutely valid for some people, there are lots of traps in that people should be aware of. The tide's changed a lot. I think in the last 12, 18 to 24 months, so the last couple of years, and the latest analysis that we've seen and conduct, is there are over 2.4, nearly 2.5 million Australians who understand they've now got an advice need and intend to see a financial advisor in the next 18 months.
If we statistically look at that and we sort of throw it in an AI model for the fun of it, it works out to be about 12% of the population, adult population.
Yeah, and you unpack that. Well, what are people realising that, oh, gee, maybe I do need to talk to someone that I can get to know and learn and trust and help me guide my work, because life's complicated. And I don't have a lot of time myself. I might be a great surgeon or a great restaurant owner, but I don't have the time to focus on knowing enough to understand what I don't know. So it's the known knowns and the known unknown unknowns, and it's all of that stuff. So, but that 2.5 million, 2.4, 2.5 million Australians are experiencing a lot of common things. They're experiencing a slight aging. They're getting closer to retirement. They're worrying about or wondering, well, actually, I've accrued a super. My employer's put money away for me, and that's getting to a number which is worth looking at now. And I want to know if that's going to be enough, and do I need to do anything different or change? Or they could be like me. I'm in my early 50s. I know I only look 42, but I'm not. I'm in my early 50s.
Thank God this is a podcast.
Yeah, that's right. And my mum still loves me, but I'm in a squeeze, and there's lots of me in this squeezed generation where my parents are aging. They're in their 80s now, and their health, touch wood, is good. But we're now starting to think about, well, what do they do when they need some home care or aged care, and what are the options, and how do we fund that, and what if one of them needs to go into a home and they've got to sell the house and one of them doesn't want to, or whatever. And I've got 3 teenage kids through school and getting into uni, and that's expensive, right? But for me, it's, well, how do I manage both ends of that barbell? Some people are getting more money in super now, and they're thinking, oh dear, what's going on globally? What's happening with China? What are they doing? What's that going to do to the investments? Because or the Ukraine and Russia, or the Trump election results, all of these things influence and impact the money you've got in super or your other investments you have, and they're wanting guidance. What do I do with that? Others are unfortunately coming across either sickness or health issues, and advice is also not about so much about as much or only about, well, what do I do to make money? How do I afford to do the things in my life?
Yes.
It's also about, well, what do I do to protect myself if things go wrong?
I think sort of picking up on this point in of itself is that some people sort of equate what financial advisors do is sometimes reactive. And we were talking about this just before we hit the record button. Is that financial advisors, when you're sick, you have symptoms. That symptoms triggers you to go see a doctor, right? Okay. In many cases, I think what a lot of people don't understand is a lot of people get into trouble or financial hardship or some other complex situation that they did not wish to be in, and then they seek financial advice, not understanding that advisors actually can't, in many cases, not in all, sometimes we can, but in many cases, we can't untangle things, right? a classic example, and I'm going to use an Asian demographic here. In Hong Kong, for example, everyone holds property within a corporate structure, what we know as PTY limited companies in Australia, right? Okay. In Australia, that doesn't work, right? You don't get access to the capital gains discount. You got to basically, there's a whole raft of issues. But once you actually bought it and you've put it in an entity, you can't reverse that because you already paid the stamp duty. You transfer that to yourself or another entity, that triggers another layer of stamp duty. So I think that's something that people need to understand as advisors. A lot of times we can't reverse bad decisions. And I always try to tell people in public, when I'm having a barbecue or whatever, is that if I was to dumb down exactly what I'm doing as a financial advisor, is I'm actually trying to help people to stop making stupid or silly financial decisions.
Sure.
Right? Whereas a lot of people, I still think, and I think part of the thing with Royal Commission and things like that is that, you're just commission salesmen. I mean, how do you see that running a licensee?
There was certainly a time a decade or two ago where many financial advisors were compensated or got their incomes via in recommending certain investments to the client. And in 99 times out of 100, in my experience, those investments were actually reasonably and good investments and actually reasonably in the interests of those people, no problem. But they were remunerated from the product. The product provider would give them a commission for it. That was outlawed some time ago, and I believe rightfully so. For mine, a professional financial advisor isn't selling product.
Correct.
A professional financial advisor does a few things and does them really well. They ask great questions is the starting point. They understand who a person is, and it's really about what do you want to achieve in life? What do you want to do? Where do you want to be? Where do you want to go? Sometimes people don't even think about that themselves, but being in a discussion and a conversation, being asked these questions prompts them to think about things differently. That's really powerful because if you're a little clearer in your own mind about what it is you want to achieve, and it might be really simple, modest things, which is, I just want to have a life where myself, my wife and my kids can live comfortably, go on a holiday together each year and enjoy each other's company. That's cool.
Yep.
So if you know that, then financial advice is then having a conversation. Well, how do you afford to do that? How do you want to own those assets? Do you put them in these things that you just mentioned, Jonathan, about a trust or a family company? Do I own them independently? What assets should I own? Well, what do you want to own? And how do you feel about risk? And if something happens in China that impacts Australian companies to which you would have some investments through yourself, does that mean do I go up or down? And should I own property and investments and this and that and the other? Well, that's the conversation. And the advisor's job is to say, well, I'll worry about that with you. I'll help you to determine that, and then I'll worry about those portfolios. They'll also talk about, well, that's all well and good if things go well, but what if things go wrong? What if you become unwell and can't work?
Yep.
How do you pay your mortgage? Is there a way you can supplement that income through things like income protection, insurance, etc., etc.? So it does a few things. Good financial planning asks lots of great questions. It puts control and clarity in the hands of the mum and dad to know where they are, where they want to go and how to get there.
Yep.
Then you can have control and choice about the decisions you make about how to get there. And if I'm going off track, how do I get back on track? Or if things go desperately wrong, how do I protect myself?
Yep.
It's as complex and as simple as that. For mine, I saw that, Jonathan, in a real life way, which is straddling your point, right? You can't change the past, but you can react sensibly for the future. For my father-in-law, I'm married to Joanne's, my wife. She has two sisters and a mum, and her dad got mesothelioma through asbestosis, horrible thing.
Yeah.
As he was in the hospice passing, he said, "Oh, Matt, I know you're in this financial advice sort of thing, but I'm not feeling very comfortable about it, and I want to make sure my girls are looked after," meaning his wife and daughters. Yeah. "Can you help me?" So I got a trusted financial advisor I'd known for years, and we brought him in, and we met Paul, and Paul had a claim for James Hardy and got a big payout, and he knew that he was going to get that, and a little bit of money had set aside, a little bit of life insurance, not huge, but modest. And John, the financial advisor, just constructed that in a way for him, which said, your estate will get this money. We're going to invest it this way. Your wife will never have to work again. She can if she wants, but she doesn't have to. Your daughters are going to be looked after. So what did that do? It took a dying man and the look of relief and satisfaction. Okay, I might be leaving, but I know my girls are going to be looked after. That's financial advice, mate. That's the value of it.
So it's peace of mind.
Absolutely.
Right? And you actually can't put a dollar figure on that.
No, you can't.
At the end of the day. But see that, and it goes back to the point, it's what triggers people to get that advice, which I think is the misconception.
Yeah.
Right? And I think that's something that hopefully through platforms like this, we can talk about that. Now, going back to earlier, I spoke about potential issue around property. Okay. And, Aussies love property broadly. And, I originally thought it might be an Asian thing, right? I figured out reasonably quickly that it's not. No. Every Aussie wants to own an acre block to live in and then have a range of investment properties in which they derive passive income, okay? I think it's a very simple concept.
Yep.
And I think it's something that's easily understandable, digestible, and therefore it also makes it easily...
Why is that, Jonathan? Is that because they can touch it?
I think so. Like when I speak to my own clients and they go, I hold all these properties, and I say, so why you hold this one? They said, I can drive past it. It's like 2 suburbs away from my place. And I share with them my own story, and I go, I've got a property in Brunswick East in Melbourne. I bought it off the plan in, I think, 2012 or something. It was my first investment property. It is now 13 years later. I don't even know what it looks like. The only thing I know what it looks like is the internals, because they need to do the rental manager person needs to do the inspection, right? Every 6 months and make sure no one's blown it up. Other than that, I have no idea. I don't generally really know despite going to Melbourne all the time, not really understanding the geography of Melbourne, because I don't care, because I look at the numbers, right?
Right, gotcha.
I think the thing about investing, is I think a lot of people get drawn into investment on an emotional level, right? Whether that be share trading. And we'll talk about, and I want to unpack another thing with you, which I didn't quite cover off here, but this is people's perception of risk.
Yeah.
Okay, I think and I've got a really good case that happened in the last couple of weeks with a new client, and it was just fascinating to see how there was this gap, and we can draw analogies to doctors as well. But this whole thing about property, that people can feel it and touch it and think, that this is something's easily digestible. There's a lot of marketing in the Australian arena around property and property spruikers overall. I've got a lot of respect for a number of buyers agents that are mates of mine, and they genuinely look at the needs of somebody in the same way a financial advisor goes, what do you want, right? As opposed to basically saying, this is right for you, right? Without understanding the person. Now, there is an outweighed amount of marketing towards property in Australia, in which people can they can say anything they want. When you contrast against licensed financial planners like us, we can't say a lot of things. Can you sort of unpack that for us, Matt?
Well, there's a lot of complexity around it, but I'll just say it the most simple possible way is property is not a financial product. Why is that important for people to understand? In Australia, laws are very strict and very regimented, and rightfully so, about how you manage other people's money. And so if I'm a bank, or if I'm a super fund, or if I'm a life insurer, or if I'm an investment provider, and I'm taking people's hard-earned and I'm managing and doing something with it to try and get them a return, but how do I prudently manage that and protect that person's hard-earned? And there's a lot of regulation, both at who holds the money, who the investment is, what the rules are around how you invest money, what's the rule around superannuation, right through to what are the rules around, Jonathan, how you as a authorised, professional, accredited financial advisor must, in the law, operate not in your own interests. The law actually says you must put all other interests, put your client's interest above all other interests, including your own. That's called the best interest duty. Heavily regulated. Property is not. It is not considered a financial investment. As odd as that sounds, because actually it's the biggest financial cost most people will ever have in their life. They pour most of their money into property, but it's not a financial product, which means that same scrutiny is not placed on either the developer, the builder, or I'll call it spruiker. And that's evocative language. But the person who often tries to sell, promote, market, or otherwise convince you to give them large amounts of money for you to invest in a tangible building.
Correct.
And that way they can say and do whatever they want. That's not quite true. There are within reason, but they can get up in a seminar, which is often There's lots of these property forums that go on, and they can say, invest in this, property never devalues.
Doubles every 10 years.
Yeah, go and borrow money from a bank because interest rates are low and you're guaranteed that that's going to grow in value and you're going to make, and they pick a number, 15% a year, 20% a year, or whatever it is, and you go into your unit that's based on not a lot of science. There's some, but it's not validated and it's not scrutinised, and there aren't minimum standards. And what they're not required to do, to your point earlier, Jonathan, even if what you do and your professional agents don't typically care who you are or what you do, and if that property is, or any property investment is right for you.
Yes.
They just want your money. Why? Because they're paid large amounts of commission for you to do it. Now, I would say that there are a lot of very good property investments and people shouldn't balk from property, but it should be balanced. There's a place for it.
Yes, because a lot of people that come to see me and they're maybe in their 50s or 60s and they are so outweighed in property. Most of the time it's outweighed in property. They do dibble-dabble in shares, but it's outweighed to property because it's something that they can see and feel. To this point, and I guess it's not only property, and this goes to the human psychology.
Yeah.
No one gives you free advice, right? It's not possible, okay? If you are a professional doctor, you don't give free advice. There are consequences to that. In the same way, financial advisors, I would draw quite a close analogy that if we started giving free advice, I'm not talking about the Pro Bono Advice Network, I'm so for that, right?
Yeah.
But just being at a barbecue, when you say something, there is a motivation why someone says it. If a property marketeer comes to you and says something and offers you free advice, always be cautious about why someone said that. If a financial advisor came to you with free advice, you should question it. If a heart surgeon came to you and said, this is the way you should operate, be careful what they said. Nothing is for free. Why would someone give something to you for free? There is a motivation to that.
You might not be paying them, but someone else is.
Correct. So you need to understand at the end of the day, right? Just like financial advisors, we can't take commissions anymore, right? And if that is an outcome of that, you understand where the client pays. So for us, our client pays us an asset-based fee in most circumstances, right? They are very clear on what they're paying us. I don't get kickbacks from a product provider, a platform provider. I'm agnostic to how I put their money, right? And we're a little bit different to, I believe, a number of advisors whereby, we hand on heart will always say, if we recommended you a strategy or a product, our family would have done it first. Right?
Yeah, right. Yeah.
Okay. So there's a different sort of alignment, but we're very, very clear about that. So I think, and this is not even necessarily regarded to advice, is any transaction you have in the market, understand one, what is the motivation for someone to tell you something, and also I think the other part of it is the longevity of the relationship, which I think is where family GPs and also where financial advisors, there's a critical difference. You walk into a car dealership, right? And I've completely failed in trying to sell Matt a Lexus while I was with Lexus. But when you think about when you buy a car, and you finish buying the car, how often do you call back the sales guy who sold you the car 12 months later and thanked him for selling you the car?
Never have.
Okay, why?
It's a transaction.
Exactly, right.
Well, most cars that I bought, I've walked away from not quite thinking I could have got a better deal.
Okay.
Yeah.
But you never call them back. The reason why you call the sales guy back is something went wrong with the car, right?
Yeah, that's true.
Okay. So you consider the nature of that relationship you have with the person that you're transacting with. With an accountant, it's long term. With a financial advisor, it's long term. We have to be very responsible with what we say because we do take responsibility for the strategy that we put you in. In the same way, if someone sells you a property, no one calls back the agent 12 months later and says thank you.
No, I'll call them back 12 months later if I want to flip it.
Correct. But again, that's the nature of the relationship. And I find that people that want to have a short-term relationship with you because it's transactional has a very different way of communicating than someone that requires a sale to get paid. And I think that's a pro tip.
Yeah, and it's a really good one. And I think people should trust their antenna. Hopefully they make the decision or recognise talking and seeking an advisor is a good one. I always recommend, as I know you and Jonathan, you speak to 2 or 3 because actually the technical competence, yes, you've got to find the right advisor with the technical competence. And now that everyone's degree qualified and stuff, there's
It's a pretty high barrier to entry.
it's a good chance you're going to find a good person trying hard to do the right thing.
Yeah.
And the next important thing is, do you get on with them? Because actually, you're going to be opening the kimono. You're going to be telling your financial advisor about a lot of personal information, and you've got to trust what they do with that. So it's a relationship.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
If we talk about, and something that obviously you're even more familiar than I am with, is in terms of, what does that industry look like now? Because we talked about a decade ago, a lot of the remuneration, or a material amount of the remuneration for an advisor, would have come from commissions and other rebates and other alternative forms of being paid.
Yes.
And that's been outlawed now. Now, one of the outcomes of that has been, we've seen Australia go from effectively around 25,000 fully licensed financial advisors down to 15,
yes.
right? What do you think the consequences of that from a supply and demand perspective? Does it increase, and does it increase trust, do you think, in the industry?
I certainly believe it has increased trust. And if you look at trust research pieces, what are the trusted professions in Australia? And still you've got nurses and mostly doctors, but nurses are more highly trusted than doctors. Interesting. Financial advisors were, a decade ago, or maybe a bit longer, were ranked relatively low, but certainly above real estate agents.
Were we we were quite, it's like, I'm sure my son in the future, he'll come back and tell me he came third in the class from the bottom. Were we that bad?
The list is fairly long. It wasn't good. It's not where I would like it to be.
Yeah.
So I think the reforms that we as an industry have been through to enforce minimum educative standards and degrees, I think that's a good thing. We've tightened up the way we keep each other accountable around our ongoing education. It's great to get a uni degree, but when did you get yours, Jonathan?
20-something years ago.
Right. So, and it's got to be contemporary. So we train each other, and we're onto things every year to make sure that we're on top and seeing what's coming, etc. Those two things alone are good, and I think that yes, the perception and trust levels are higher, and that's a good thing.
Let's talk about the cost. I know there's a bit of a reverse conundrum here, right? The cost of getting advice and the cost of not getting advice, right? And I think, sort of going back to the property thing a little bit, is that people find getting property advice, within inverted commas, it's very easily accessible. Now, we talked about 25,000 down to 15 advisors. That's an issue in of itself. Do you believe the cost of advice has been a prohibitive factor? Besides the perception issue, like you said, only if you're rich you need financial advice.
I think, the cost for a personal and professional tailored financial advice today is definitely a bit more expensive than it was as recently as 3 or 5 years ago. The value of that advice, though, is still exceptional. So why do I say that? Well, I know that people who get good quality financial advice, the return on that advice is the peace of mind and the intangible things. But on a number of fronts, being the performance of the portfolios they're in. It's selecting the right super fund with lower fees. It's ensuring that I'm insured and paying low premiums, protected so I can make a claim when I need to. It's making sure that my tax structures are right, and so I'm actually paying less tax. So if I paid you, Jonathan, I don't know, $5,500 or whatever it is for the piece of advice, and then I'd pay you an agreement for you to monitor that with me and for me over each year, the outperformance would be many times higher than that fee that you've paid me. So I think the return on that investment is undeniable. Into the future, I can see, hopefully, as we get better things and tools for people like you, Jonathan, better technology, so you can do your job faster, better, cheaper, that may enable you to perhaps say to your clients, well, I can do the same work for you, but because my costs are lower, I'll give you we can do that for a little bit less, and maybe that enables you to do it for a few more people. That's great. I'd actually contemplate for people that even if they don't think they're getting advice today, I'll guarantee that they are.
How so?
So in Australia, it's compulsory to have superannuation, and your employer must, here's just one area, and your employer must put that money into super for you. And for this year or next year, is it this year?
From July 1.
Yeah, it goes to 12% of your salary goes into superannuation. That's compulsory saving for your retirement. It's actually a good policy in my personal view. Even if you are disconnected, you actually don't care, you're agnostic, you just let your employer pick a fund and put it in for you. And then within that fund, what that fund will do is say, well, what I know about you, Joe Blow, is that you're 35 years old. You haven't told me how you want to invest the money, but I'm going to invest it in a way which is typically prudent for a 35-year-old because they've got another 30 years to retirement. So you have to have a longer term time horizon. So they will build a portfolio for that 35-year-old, not based on what you actually need, but based on assumptions about a generic 35-year-old male, female, if that's the case. So that's advice. It's just that you're not aware of it. It's not personalised. It's not tailored. They're not taking into consideration who you are or what you want. So they're just making assumptions and they're giving you advice. And in fact, by default, your employer, who has selected a fund, superannuation fund to put it in, has also done that advice for you.
Yes.
So in my mind, and maybe it's just me, I'm sure it's not, but I want more clarity, control. I want to be the one working with a trusted partner to make the decisions, not based on what I can do, but based on what's right for me. Yeah. And I think that's the difference, yeah.
It's funny, like say someone that comes to us from an industry super fund, and then, as part of our fact find process, give us your latest statement, let's go through it, let's dissect it, let's look at what costs look like, and, returns and asset allocation and things like that, and insurances, which are also another critical point. And to your point, they believe, I think a proportion of people believe that they're getting advice from their super fund, and they're only getting charged $100 odd because it's a line item called admin fees every year. But then they look and it says, I need to pay you thousands of dollars a year. But I'm getting advice. I think this is to your point.
Yeah.
Right? But they can't, I think a lot of people don't differentiate personal versus general advice, right?
Yeah, that's right.
Not tailored to your needs. Flipping the coin to the other side, Matt, what do you believe is the cost of not getting advice?
It's a difficult one because it's kind of you've got to compare where you are to a hypothetical alternative course that you may have taken. So if I were to sort of concentrate that down, what is the cost of not getting advice? Well, you don't know if you're in the right thing for you. Yep. You don't know the opportunities you've missed out on, and more often than not, it's where things go wrong or there's some form of trigger where you find out when it's too late that you're in trouble. Now, we are lucky in this country because we've got a regulated country. We've actually got compulsory super, as we've just spoken about. We've got investment markets which do pretty well, and most of our super funds who are heavily regulated do a pretty good job. And so even those who are most disconnected and actually don't care and agnostic about it, they're still pretty well looked after. Going along, it's okay, but it's not great.
One of the things that I think is the cost of advice, and this is an Australian, economic and structural issue, and I think it's something that the government contends with, is that I think there's still a material proportion of Aussies that go, I've worked all my life, I've paid taxes all my life, I get to 67 now, and I'm going to get the age pension. Okay. Now, there's a couple of facts that I think people need to know. One, that you notice that over the last decade that the age pension eligibility age has been creeping up.
Yep.
That's a fact. Number two, there was a study done by, I think, AIA or Zurich many years ago that looked at 30 years ago, because it was done in 2016, that's where the numbers came from. So in 1986, if a couple was on the full age pension, about 85% of their living needs and costs would be covered by a full age pension. 30 years later, and over the course of that 30 years, the full age pension in dollar terms had grown by 3 times. And by 2016, if you were a couple on the full age pension, you would only be able to cover something like 38 to 40% of your living costs. Okay.
Yeah.
This is pressure. This is a very obvious pressure on the system itself, not to also then include the demographic issues of baby boomers retiring.
Yep.
And there's a huge issue with there because there's less people paying tax. How sustainable is that pension system? And I always ask new clients that come in that do raise this point of how do I get Centrelink, or how do I get what it's called Services Australia now? And I say, don't ask me about that. I want to ask you a question first. It says, in retirement, would you rather rely on the government or rely on yourself, right? So if there's any government official out there, I'm sure you'd love listening to me talk about this, because there is these inherent pressures on the system and the eligibility issues, they keep rising. And so if you rely on the government and the government can't afford to pay you anymore and it leads to a diminishing, standard of living, isn't that, not to put everyone into fear, but isn't that a trigger point to go, what else can I do about my financial life to be able to rely on myself and not rely on the government? Because that is unsustainable.
I think that's really prudent thought process, Jonathan, because if you look at the demographics of an ageing Australia, a lower proportion of the population are paying tax. So consolidated revenue, the public purse, isn't growing at the rate that it once did. And so they're going to make it more restrictive and the payments lower. So I think what you're saying, I'm agreeing loudly with what you're saying. And my counsel to people would be, think about having 3 C's: clarity, control, and choice. You choose. If you're clear about where you are, so you've got clarity, you can control and choose what you do. And if getting the age pension or a portion of it's important to you, you can structure yourself so you get that, even if it's a bit of it. All right, so you get what's owing and
or get the healthcare card and whatever.
Yeah, that's cool. Yep. But at least you've done it in a way where you've had clarity, control, and choice, and not being forced to do it and live, perhaps a quality of life that in your retirement years won't be too much fun because you won't be able to afford to do it.
Yeah, correct. Before we talk finally about regulation, there was one other part, speaking as an advisor to a non-advisor but running a dealer, is this concept of people's risk perceptions.
Yeah, right.
So I had a client coming in and, we assess their risk and we've got a risk profile questionnaire, but that's not the be all and end all. That's a computer thing, right? You answer it, you come up with a score, and then we have a discussion. The client came out as balanced, right? And the way that they answered, because, I'm a bit more thorough and actually look at how they answer the questions. And then I looked at what they do. The husband has a US shares trading account, and I asked does your husband hold them long term or does he like to trade? He goes, oh no, he likes the excitement of trading. Then they own 2 investment properties, of which they geared basically at 80% or over 80% because they drew the equity from the first one that went up in value.
Yep.
And a mortgage broker convinced them to draw more equity to buy another property and so on and so forth. And then they realized maybe this is a bit too much debt. Now they then told me, oh yeah, we're risk adverse people. We don't like risk. Then I'm like, yeah, exactly, too right. But to the contrary, this is what you do. And I was talking to my team about it. I used it sort of as a training case study because obviously I'm using this example because it's recent, right? But I've seen it a lot. And I was trying to train my staff to understand that when you get someone else to be responsible for your decisions, you want them to be more conservative than what you perceive to what you do yourself, right? So if a doctor said you've got a terminal illness of some sort and said, I can operate on you, and it might cure you, but there's a 50% chance you'll die on the operating table, you will likely say no, right?
Depends on what the runway is.
Yeah, depends. Yeah, but you sort of understand the analogy.
Yeah.
I find this very interesting that people have I'm a conservative person, as an independent professional looking at it, right? I think you're taking excess levels of risk. I mean, do you think people have broadly in your community and people that you see also have that sort of issue? Because it's sort of like, another analogy I draw it to is, I said this to the client at the initial consultation. I said, if you have a room full of 100 people and you ask how many of you believe you're better than the average driver, 80 people put their hands up, right? But statistically that's wrong, right?
Yep.
What do you think about that in terms of people's risk perceptions around investing?
I think the examples you gave are really, really interesting. I actually don't think the majority of Australians, though, actually think about it at all.
Interesting.
They're disconnected from it a bit, and maybe there's a link to being disconnected with it because they actually don't get up every morning thinking about my super fund or my bank account. You just don't do that. I'm more interested in property prices because it seems to be on the news all the time. But when you ask a question about, well, how comfortable are you with losing your money? So you have 0 in your bank account, and then they go, oh, hang on. So it's not tangible enough. And I think we've done a poor job in this country educating ourselves on financials and what does investment return mean? What is risk? What is terms like volatility on things going up and down in value and actually means nothing until you go and sell it, right? So
yes.
it's just a number
Paper
on
gain, yes, paper gains.
So actually, Jonathan, I think the issue is people don't think about it. And that drives back to the conversation we had earlier, which is it's one of the very reasons I think people need to start talking with a trusted advisor where they can have that clarity or a better understanding about it. Not to become an expert, because I want to know enough to know that I can rely on my advisor to do it.
Yep.
I know nothing about cars. My mechanic started to teach me about cars, in particular the noises and stuff. And I said, why are you teaching me that? I'll be able to fix stuff myself. He said, no, you won't. But you'll know when things doesn't sound right or feel right, and you'll come back to me and I'll help you sort it.
Yeah.
That's the bit about, that's the approach I see.
Yeah.
And that's risk management. Knowing when things don't feel right, enough to ask the question.
To sort of finish off, let's talk, because you're at the coalface more than I am as a practitioner, is regulation. One of my, again, a pet peeve of mine around regulation is the tax deductibility of advice fees. And there's been some developments in that, and we've got news licensing rules in place for that as well. You go see your accountant every year. The cost of seeing that accountant, otherwise known as item whatever, managing your tax affairs, is a 100% tax deductible item. Financial advice, well knowing what I said about getting good, prudent financial advice sets you up financially better in the future, you having to rely less on the public purse. Are we making any reasonable headway, in your opinion, around, this is just one example about tax deductibility advice, but are we making any ground, you think, in trying to make advice more accessible in the current environment?
Absolutely. And I think quite rightly, our profession, our industry of financial advice was under the spotlight for the last, decade and a half, and regulatory reform has made it very tough. A couple of things say to me that the government, whether they be Liberal or Labor or whatever persuasion, also agree that this has been a tremendously important area that people need to focus on and encourage it. So having movement so that financial advice is now more readily understood and is tax deductible is an indicator, Jonathan. Yes, that the government says, well, we need to make it more affordable. So let's enable and allow people to make a tax deduction. There is a whole range of regulatory reforms in front of Parliament as we sit here today and speak that are designed to make advice more accessible, more understandable, more cost effective for you to deliver, i.e. take your input costs down so that you can afford to give advice to more people and the price points come down, etc., etc. The very notion that we have a financial services minister, so governments, and we have now for probably a decade or more, whose job it is to focus on things like financial advice and superannuation, indicate to me they take it so seriously in Canberra because it's a big issue. Regulation and government changing the rules to make it easier and better and a better client experience to get advice. That's alive and well, and it's really well received.
Why isn't something that's always perplexed me is, why isn't initial advice tax deductible? Because that's the trigger, isn't it? In the same way that, I don't know, it's a little bit of a longer bow, but it's like saying the first year's premiums on an income protection policy are not tax deductible. It's like you've got to be committed, and then then you'll get the benefit from tax.
Look, there are theoretical arguments about that and what's a capital cost versus an income generating cost. Yeah. So to set something up is a capital, and then we'll give you some deductions on the income as you go. Look, we could get into it. We could spend an hour talking about that one. Yes. But in a crude way, that's probably the most succinct reason for that. Who knows? We'll fight the good fight. We never say never for the future.
But I guess your point that you're coming across is, watch this space, because there is movement to try to get it more accessible, which is the critical point.
Absolutely. To make it more attractive for financial advisors or people to choose financial advising as a career, for the costs to come down, for the accessibility and the choices for people to have. It's about where they go to get advice, whether it comes to a professional unit like you and your business, Jonathan, or whether I go to a superannuation fund who may employ their own advisors and get advice from there. We support all of those, so long as people are getting that clarity, control and choice. I think that in the end of it, works for everyone.
To sum up, if you were in an elevator with somebody and you had 30 seconds, the elevator pitch, as to why you should see a financial advisor today, what would you say to that person in the elevator? Knowing that they had a need, of course.
It's a damn good question. I struggle to say things in 30 seconds.
Yeah, I know that.
I said, what price do you put on your own peace of mind? Having your own choices in life, if that's important to you, well, then you must see a financial advisor. If I had an extra 60 seconds,
Yeah.
I would tell them the story, which I've told
Yep.
your listeners around my father-in-law,
Yep.
and just the satisfaction it brings to be able to provide.
Yeah. I mean, what I've always said to people in 30 seconds is, what's your definition of financial success? That's how I open all my conversations, because that is a very open-ended question that allows people to express what they want out of life, which I think at the end of the day, to what you pointed out very clearly at the beginning, is us as the ability to actually ask the right questions to see what you want. And a computer can't do that, right?
No.
Human relations can't do that. When markets have corrections, we can't do that. And that's where the value advice is. So Matt, thank you very much for coming on the show, and hopefully we can talk about regulation if someone wants to listen to us for another 2 hours on another episode.
Those poor buggers. Yeah, thank you, Jonathan. Good to see you, mate.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.